Not all refinances are about pulling cash out. Sometimes it is just about getting a better deal. Section 1. The smart refinance. It is not always about the cash. When you hear the word refinance, your mind might immediately jump to those commercials promising a pile of cash to remodel your kitchen or pay off high-interest credit cards. While that is certainly one way to use your home's equity, it is far from the only option. In fact, one of the most powerful and strategic moves a homeowner can make does not involve pulling a single dollar out of their property. It is a straightforward, savvy play designed for one simple purpose: to put you in a better financial position with the mortgage you already have. This is the world of the rate and term refinance, a tool that is all about improving your loan, not borrowing more against it. Think of it as giving your mortgage a much-needed tune-up. Your home is a massive investment, likely the largest one you will ever make, and the loan that comes with it is a long-term financial commitment. Over the years, things change. Interest rates in the market fluctuate, your personal financial picture might improve, and your long-term goals can shift. A rate and term refinance is your opportunity to adjust your mortgage to reflect these new realities. It is a deliberate choice to optimize your loan by securing a lower interest rate. So, what exactly is a rate and term refinance in plain English? Let us break it down to its most basic parts. Imagine your current mortgage is like a subscription service you signed up for a few years ago. Now, the company is offering a new, better plan for the same service. A rate and term refinance is like switching to that better plan. You are simply replacing your old mortgage with a new one. The new loan's primary purpose is to pay off the old one completely. The key is that this new loan comes with a different set of rules. Rules that are more advantageous for you, the homeowner. The name itself tells you everything you need to know. Rate and term. Rate. The rate refers to the interest rate, which is the percentage the lender charges you for borrowing the money. Securing a lower interest rate is often the number one reason people choose this path, as it can lead to immediate monthly savings. Term. The term refers to the length of the loan or the amount of time you have to pay it all back. 15 years, 20 years, 30 years. The most important defining feature is what it does not do. It does not allow you to take cash out of your home's equity. Your new loan amount will be very close to what you still owe on your existing mortgage. You might be able to roll the closing costs into the new loan, which could slightly increase the principal balance, but you will not walk away from the closing table with a check in your pocket. This is what makes it fundamentally different from a cash-out refinance. It is a clean swap, designed purely for loan improvement. Because you are not taking on additional debt or cashing out your equity, lenders often view rate and term refinances as less risky. This can sometimes translate into a smoother approval process and potentially more favorable interest rates compared to cash-out options. In the eyes of a lender, you are simply shuffling your existing debt into a better package. You are demonstrating financial responsibility by seeking a more manageable payment or a faster path to being debt-free. It is a disciplined financial move that strengthens your balance sheet rather than leveraging it for immediate cash. The process of a rate and term refinance might sound complex, but it is actually quite logical and follows a series of clear steps. It all begins with your decision to explore a better deal. First, you shop around and apply for a new mortgage with a lender. This lender could be your current one or a completely new financial institution. The lender will then pull your credit report, verify your income and employment, and assess your overall debt-to-income ratio to ensure you qualify. Once your application is in, the lender will order an appraisal of your home. This is a crucial step because the lender needs to confirm the current market value of the property. The value of your home helps determine your loan-to-value ratio. Loan-to-value is the percentage of your home's value that is being financed. A lower loan-to-value, meaning you have more equity in your home. Homeowners opt for a rate and term refinance for a handful of very practical and financially sound reasons. By far, the most common motivation is to lower the interest rate. If market rates have fallen significantly since you first got your mortgage, you could be leaving a lot of money on the table by sticking with your old loan. Even a small reduction in your interest rate can translate into substantial savings. It lowers your monthly payment, freeing up cash for other goals. It reduces the total amount of interest you pay to the bank over the life of the loan. Another popular goal is to reduce the required monthly payment, which provides immediate budget relief. This can be achieved by securing a lower interest rate or sometimes by extending the loan term. For instance, if you are 10 years into a 30-year mortgage and your financial situation has become tight, you could refinance back into a new 30-year term. While this means you will be paying on the loan for longer, it spreads the remaining balance over a fresh timeline, which can dramatically lower your monthly obligation and make your housing costs more manageable. Many homeowners also use a rate and term refinance to gain stability by switching from an adjustable rate mortgage to a fixed rate mortgage. An ARM can be great initially, with a low introductory teaser rate. However, after that initial period ends, the rate can adjust based on market conditions, leading to unpredictable and potentially much higher payments down the road. Refinancing into a fixed-rate loan locks in one consistent interest rate for the entire loan term, giving you peace of mind and a predictable payment you can count on for years to come. Finally, some financially ambitious homeowners go in the opposite direction. They shorten the loan term. People who have seen their income grow might choose to refinance from a 30-year mortgage into a 15-year mortgage. While this move often results in a higher monthly payment, the benefits are huge. You typically get a lower interest rate with a shorter-term loan, and you pay off your house in half the time. This strategy builds equity at a much faster pace and can save you tens or even hundreds of thousands of dollars in total interest payments over the life of the loan. Understanding the difference between a rate and term refinance and a cash-out refinance is absolutely critical. They serve entirely different purposes and are viewed differently by lenders. The distinction is simple. Are you taking money out of your house? Rate and term refinance. The answer is a firm no. Your new loan is structured to be just large enough to cover the remaining balance of your old mortgage, plus any closing costs you choose to finance. The goal is loan improvement, not liquidation of equity. A cash-out refinance, on the other hand, is designed to borrow more than you currently owe and receive the difference as a lump sum of cash. For example, if you owe $200,000 on a home worth $400,000, you might take out a new loan for $250,000. That new loan pays off the original $200,000 mortgage, and you get a check for the remaining $50,000 minus closing costs. You are using your home's equity as a source of funds for other things: home renovations, debt consolidation, college tuition. This fundamental difference in purpose leads to different rules and risk assessments from lenders. Because a cash-out refinance increases your total loan amount and reduces the equity cushion in your home, lenders see it as a higher-risk transaction. To compensate for this added risk, they often impose stricter qualification requirements. You might need a higher credit score or a lower debt-to-income ratio to be approved. Furthermore, the interest rates offered on cash-out refinances are frequently slightly higher than those for a comparable rate and term refinance. Think of it this way. A rate and term refinance is like renegotiating the terms of your existing car payment to get a better interest rate. Your debt amount stays the same. You just pay it off more efficiently. Knowing when to pull the trigger on a rate and term refinance is just as important as knowing how it works. The most obvious signal is a significant drop in prevailing mortgage rates. The general rule of thumb used to be that a refinance was worth considering if you could lower your rate by at least 1 full percentage point. However, with today's larger loan balances, even a half-point reduction can lead to meaningful savings. If you bought your home when rates were at a peak and they have since fallen, it is the perfect time to run the numbers and see what you could save. Another prime opportunity arises when your personal financial profile has improved substantially. Perhaps your credit score has jumped 50 points since you first bought your home. A higher credit score is one of the most powerful factors in determining your interest rate. Lenders reward borrowers who have a proven track record of managing debt responsibly. If your score is significantly better now, you likely qualify for a much more attractive rate than you were offered initially, even if overall market rates have not moved much. It is your reward for being financially diligent. A change in your long-term financial goals can also be a powerful trigger for a refinance. Early in your career, a 30-year loan with its lower payment may have been the right choice. But now, perhaps you have received a promotion, your income is higher, and you are more focused on building wealth and becoming debt-free before retirement. This is the perfect scenario to consider refinancing from a 30-year to a 15-year mortgage. You can accelerate your equity growth and slash the total interest you will pay over the long run, aligning your mortgage with your new life priorities. Finally, an increase in your home's value can make a refinance easier and more beneficial. When your home's value goes up, your loan-to-value ratio goes down. If your LTV drops below 80%, meaning you have at least 20% equity, you may be able to refinance to eliminate private mortgage insurance. PMI is an extra monthly fee you pay when you have a low down payment, and it provides no benefit to you. Refinancing to get rid of it can save you $100 or more each month, making it a very smart financial move. Let us look at a simple scenario. Imagine you have a $300,000 balance on a 30-year mortgage with a 6.5% interest rate, a loan you took out in 2023. Today, in early 2026, you see that rates have dropped. You qualify for a new 30-year loan at 5.0%. You go through the refinance process and your new loan pays off the $300,000. Your monthly principal and interest payment drops from approximately $1,896 to $1,610. That is a savings of nearly $286 every single month, all achieved by simply swapping your old loan for a better one without taking out any cash. While a rate and term refinance can be a fantastic tool, it is not a universally good decision for every homeowner in every situation. Refinancing is not free. You are taking out a whole new loan. This comes with expenses like appraisal fees, title insurance, lender origination fees. These costs can total several $1,000s. You must calculate your break-even point, the number of months your monthly savings cover the upfront costs. If you are not saving enough each month, the break-even point could be years away. How long you plan to stay in the home matters. If you might sell in the next 2 or 3 years, a refinance is often not worth it. For example, closing costs $4,000 and your monthly savings are $150. Your break-even point is about 27 months. If you sell the house before you hit that mark, you could actually lose money on the transaction. If the available interest rates are only slightly lower than your current rate, say an eighth or a quarter of a percentage point, the math might not work out in your favor. The minimal monthly savings may not be enough to justify the cost and effort. Ultimately, a rate and term refinance is a strategic financial move, not an emotional one. It is about putting yourself in a measurably better position. Lower your monthly payment, lock in the security of a fixed rate, accelerate your journey to owning your home free and clear. However, it is not a one-size-fits-all solution. You have to weigh the costs against the savings and consider your future plans. If the numbers work and it aligns with your goals, a rate and term loan is not about pulling money out. It is about putting yourself in a better position.